This jobs data report coming out on Friday is going to be a huge market event this week, because it's also the latest jobs data that will be before the Federal Reserve has to make decisions on whether or not they're going to be keeping the interest rates where they're currently at or start lowering them again. Now, what we are currently seeing is continuing unemployment claims are rising, and they're up about almost 10% year to date. They've kind of haven't gone over 2 million Americans staying unemployed. So we're constantly staying around that, 1.95, 1.96 million Americans are just staying unemployed, meaning that it's being harder for them to find work. The initial claims hasn't really spiked on a continuous trend. There's definitely been some seasonality of initial claims spiking and then coming back down. But we want to really focus on that unemployment data, on continuing claims, because that actually leads the overall unemployment rate. And so if that starts to go above 2 million on a consistent basis and start trending even higher, that means that the unemployment rate, which is currently, I think, around 4.2, 4.3, will actually then start to go higher. So continuing claims will lead the future unemployment rates. And so the Federal Reserve is going to be focusing on that and basically abandoning getting exactly to the 2% target.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And I mean, we're not just here, we're now in a $41 plus silver futures era. Greg, you and I were young bucks back the last time that happened, 2011, and now here we are. It amazingly took 14 years, but as of Tuesday, I'll pull up our pricing today because yeah, in a little bit of different territory, and Greg Crennan, who, in addition to being one of my dear friends, also the chief market strategist at Golden Coast Consulting and the founder of the Golden Coast Journal, who has not only been following gold and silver. Where's our silver price? There we go. Live ticker, we're at 41.55 on the futures right now, which happy Labor Day weekend to all of these silver investors out there. It broke 40 on Friday, 41 on Sunday night. And as I mentioned, we are here with not just Greg Crennan, but we are here with the Punisher of Wall Street, which I know makes everyone happy because we have people who are not the biggest fans of Wall Street. And anyway, Greg, there's a long, meandering introduction, but a pleasure to have you back on the show for your latest update. How are you today?
Great, Chris, and feeling great going into the end of the year here in 2025. It's been a great year for my clients as well as subscribers at the Coastal Journal. As we've been talking about the rise here in silver and the record high gold price of over $3,500 an ounce. So sitting pretty well this year.
Yeah, well, that's good, and I'm happy about that. Although I know what the crowd really wants. So like enough of the nice stuff now. Here's Jerome Powell, and here is where to go. There's the Punisher. And I know there's a lot of people who are not happy. Well, Greg, I mean, I guess in some sense, gold and silver investors probably not happy with what Jerome Powell is doing to the world yet. Man, we should get him to give another Jackson Hole speech. We might hit $50 by Friday, but let's start there because it sure seems like this latest leg that has pushed us through 40 really started at Jackson Hole 2.5 weeks ago now, I suppose. And some of the comments were intriguing, fascinating economic theory, which we'll play one or two of those. But any thoughts on the metals coming out of Jackson Hole over these past couple of weeks?
So I think actually if the data continues to weaken what we're seeing in the job and labor market, because there's been massive revisions this year, hundreds of thousands of job losses that have actually been revised out of the jobs data. And so I think that jobs and labor data is now the key focus that the Federal Reserve is focusing on. And they've basically have abandoned trying to get the inflation target to the exact 2%. And what their logic is that if the labor market weakens drastically, then that's going to have a kind of like a doom loop in the economy, because if less people are working, that's less income, that's less income, that's less spending, and then that's bad for businesses, and then you go into this bad loop, and that's how basically recessions happen. And so when you're looking at that jobs data, which this jobs data report coming out on Friday is going to be a huge market event this week, because it's also the latest jobs data that will be before the Federal Reserve has to make decisions on whether or not they're going to be keeping the interest rates where they're currently at or start lowering them again. Now, what we are currently seeing is continuing unemployment claims are rising, and they're up about almost 10% year to date. They've kind of haven't gone over 2 million Americans staying unemployed. So we're constantly staying around that, 1.95, 1.96 million Americans are just staying unemployed, meaning that it's being harder for them to find work. The initial claims hasn't really spiked on a continuous trend. There's definitely been some seasonality of initial claims spiking and then coming back down. But we want to really focus on that unemployment data on continuing claims, because that actually leads the overall unemployment rate. And so if that starts to go above 2 million on a consistent basis and start trending even higher, that means that the unemployment rate, which is currently, I think, around 4.2, 4.3, will actually then start to go higher. So continuing claims will lead the future unemployment rates. And so the Federal Reserve is going to be focusing on that and basically abandoning getting exactly to the 2% target. But that's another story for another conversation.
I thought you were going to say if the claims go higher, then Trump's just going to fire the guy who's calculating those. I mean, that was pretty wild I guess that was a month ago already, where I think, as readers of the Coastal Journal know, most of these numbers are pretty ridiculous in general. But on one hand, Trump's out there calling Powell a loser every other day, then firing the guy calculating the labor numbers. It just maybe it's just me. It doesn't seem like, if you're an outsider, like the best look. Am
No,
I?
absolutely. And so this is where, as investors who are looking at what Trump is doing, he's actually, by him being so erratic and not being rational about his decisions, is actually causing more fear in the market. And to me, what I've always discussed here on your podcast is that gold is a fear hedge, meaning if there's geopolitical fear, just political, US local political fear, or is it trade fear, or recession fears, gold is the ultimate safe haven. And usually when the VIX spikes, which it has this year, it's back down at this current moment, but when the VIX spiked in the early March Trump tariffs, which I also put out information to people ahead of time, gold actually went up. And so again, when you have fear and turmoil in the markets, the price of gold does extremely well. And so if you're worried about a possible recession, if you're worried about maybe interest rates rising, if you're worried about Trump being a loose cannon, you don't want to be in risk assets like stocks that are overvalued. You want to be, investors are seeking gold, and now they're seeking silver because they see the value of silver being under its record high of 50, or 52, I think was the record high. But anyways, we'll say 50. And so, you could have been buying silver in the 20s, high 20s this year. I think the lows this year were $27 an ounce, I believe. And so, you could have loaded up on silver at way lower prices. And now you're up over 30% year to date, where gold's sitting over $40 an ounce today. So again, the metals run is driven on all kinds of different fear. It's not, I won't call it just an inflation hedge. I look at it as more as inflation gets so tied up because everyone wants their thesis per se to show. And so they say, well, the inflation numbers are going to be 10%. And so you want to own gold and silver. I mean, that could be true. But if inflation reported is just stubbornly high where it's at right now and doesn't really elevate to 10%, it doesn't go to 2%, let's say it stays in this 4% range, it's being reported at 3%. But I think you and most of the people who watch this would say that inflation is probably more around like the 5% range. than what's being reported at around on the core CPI and even the core PCE, which is around 3% on a year-over-year basis. And you don't expect inflation reports to come in and then expect the price of gold to silver to just balance that inflation percent change. I think a lot of people put that out there because when they're trying to explain to a mass amount of people, they just assume inflation and own gold and silver. And I look at it more as a overall society hedge, meaning that you want a real asset that can be continue to hold throughout governments, throughout currencies, that maintain their elemental values that can't be changed. And that's why having a core position in gold and silver for everyone now is probably more important than ever.
Yeah, and along those lines, you mentioned that gold responding to fear more than anything else. And Punisher, I don't know if this is connected to Jerome Powell being fearful that I'm about to give you like throw some steak in front of my punishing dog over here with one of his clips. But as we are recording here on Wednesday, gold futures up to 35.89. Goodness. Happy Labor Day weekend. Looks like the high so far today was 35.91. Any thoughts on that? We got another 15 minutes or so left here. Are we going to hit 3,600 before we're done here, Punisher?
I mean, the way that things are going, it wouldn't surprise me. But gold's had a great run so far in 2025, and so for all the people who bought gold and held out and didn't want to chase the AI herd, they're being rewarded this year, and so that is one of the things that's great about being able to think outside the box. Gold, unlike stocks, they don't get, gold does, there is no like gold cheerleaders. What I mean by that is when you
Well,
turn
there's
on,
a couple.
it's true, but I mean, when you look at like CNBC or Bloomberg and they're talking, it's all about the craze hype of AI, which will be most likely very transformable as we're starting to see some changes already today. But just like in the internet peak of the dot-com bubble, the internet was the future, but that didn't equal returns on investments if you invested at the peak in 2000 and 2001. A lot of the money, a lot of the things, even if you invested in bellwether companies, took years to break even if you invested. And so, now is with stocks actually being, I would think the most overvalued in US history, now is a time to, hedge and have gold and silver in your portfolio if you don't already have so, because we're seeing stocks like Supermicro and CoreWeave, who were supposedly the two additional AI beneficiaries of the NVIDIA GPUs. And what we're actually seeing is Supermicro just announced that there's going to be some financial accounting issues, which is what I actually reported for the
You
close.
were writing about that last year. I remember getting it in the journal, so I can confirm that.
Not only that, but I dug deep into their recent report at the beginning of August. And one of the strategies was loading up on at the time, $55 puts that are up substantially since
Ooh, juicy.
August. And one of the other companies, CoreWeave, they make absolutely no money. This was one of the hot IPO stocks that were on the run this year at the IPO, thinking that this was a huge run. And when you actually look at their financials, they've actually specifically used a Enron-like accounting trick called hypothetical future value, where they literally just assume bookings of future revenue and they booked it on their earnings report, meaning that they assumed of $30 billion in sales of 2 years out, and they booked it on their books, but there is no cash. And so there are companies that is massively in debt, and this company's feeling it today, down 11% as we're talking about it. And so if this really is the bursting of the AI bubble today, as we're talking, you're going to want to own a real asset, because these companies that are now crashing, they don't make any money. And so if you're invested in these things, you're going to get crushed. And so you want to have an asset that will survive during these this upcoming possible downturn that we're starting to see. Because 11% down days is not normal. Like we're not going to see gold down 11% in one day. Even when you look at gold over the past 25 years, gold went down 20% twice, and it took like an entire year for the price of gold to move down 20%. And so when you're looking for a store of value, when you're worried about not losing a portion of your net worth, gold is, gold reliable.
So a little different than Core Weave Inc., which, like you pointed out, you got some puts ballooning up on that one today too, Punisher.
Oh yes, yeah. So
Oh, that's where the smile comes from. It's nice to own puts on days when the stock is down 11.46%. I didn't have many of those back in my option days, but
when the company reported earnings, I think it was also the beginning of August, I did a deep dive and explained exactly how fraudulent this company is, and warning investors that you should clearly stay away from this company.
man, I wish I'd known you.
Also, insiders sold a record amounts of money, meaning like they're ringing the register and they're getting out. So that was another signal that this was a nice pump and dump on Wall Street, and that's one of the reasons why I do what I do, because I want to make sure that normal people don't get suckered in and take on losses. So I want to give out the correct information so that people can make their own informed decisions instead of just believing any type of hype and pump and dump schemes.
Note to pump and dump CEOs: you can't slide that past Punisher. He's gonna knock that curveball. You dang it in the middle. He's gonna take care of it. Although Punisher, here's something that we have talked about before, and be curious to get your opinion on this. Now, on one hand, if you have a company that completely collapses, can be a different story. Although, in a broader sense, I just continue to wonder, at the end of the day, will Washington and the Federal Reserve allow the stock market to ever fall in a meaningful, substantial way? I'm not saying that the tactics they would take to prop it up would be great from a long term perspective. And before you answer, I'll also toss in something that Luke Groman points out a lot, where a lot of the tax revenue is coming from capital gains on the wealthier class. So that creates an even bigger funding issue from a deficit perspective if that were to happen. And I know you've thought for a while we're close, and you suggested today maybe this could be a popping of the AI bubble. But what would you say to the school of thought that, well, maybe it should, to the degree that we need to be looking at what will happen? Will they ever allow that? What would you say there, Punisher?
Well, I would say that when you look at the overall market and actually look at how companies have done this Q2 earnings report, which I did a lot of detailed analysis on some of the hottest stocks out there, they're actually burning through cash flow. And when you burn through cash flow and you're not making money on these AI investments like they've had, then you're going to have to do cutbacks. And so when you're looking at future, because you're buying, say, the overall stock market, and you're looking for those future returns, and those future returns don't start to materialize, eventually it will pop. And it may not pop on a drastic scale, like, say, 50%, like we've seen in 2008 or in 2001 and 2. But individual stocks may absolutely get crushed. If you look at, like we're seeing today, stocks are down, some stocks, individual stocks are down 11 and 12%. So maybe the indexes don't crash 50%, but individual stocks could go to zero, and we're starting to see that happen right now. And so when you're looking at such a dramatic downturn, just because how much money is out in the overall stock market, the Buffett indicator is 200% to GDP. And so that means if our GDP is somewhere in, we'll say 30 trillion, the stock market's worth 60 trillion, that, it could fall just because of it has previously, actually the Buffett indicator has never been this high. And Now, the other issue is, okay, maybe if the stock market indexes don't fall that much because of what we're maybe saying, that doesn't mean that you'll benefit as far as a return on investment. And so that's what we're kind of seeing now is gold and silver are drastically outperforming the stock market this year. And they get no media hype like the AI bubble does. So if the NASDAQ, which is the pure AI index symbol, I think it's up now with today's down day, I don't know, 7% year to date. Well, gold and silver are up over 30% year to date. So I'd rather take those gains over the stock market's gains. And there is so much about AI investing that the NASDAQ index is only up 7% year to date. So to me, it's like, well, that could happen where maybe stocks don't crash, but that doesn't mean that that will help you and your where you're trying to do your investment, your portfolio, and your purchasing power going forward.
Yeah, I know what you mean. And by the way, in case any of that was happening quickly and people are wondering what are companies that you want to look at, fortunately, Punisher writes that all down here at the Coastal Journal. Link in the description field below. Punisher, I don't, I'm actually finishing up a silver report, and this is one of the later sections. I'll have to check the current numbers, but at least as of a few months ago, silver had actually outperformed the NASDAQ since the year 2000, believe it or not, which is hard to imagine when you think about how, geez, the NASDAQ has kind of done a 10Xer since the bottom of the housing bubble. Again, you could change the dates because you go from 2000, you still had the bubble popping. So I'm not saying over a longer term, silver has not performed stocks. And you'd like to live in a world where you wouldn't expect silver to overperform stocks. But we will leave that all aside for now and let you feast on this one because here Jerome Powell mentions, well, let's just let the maestro. If Greenspan was the maestro, do we have a name for Powell?
Oh, mm, that's a tough one.
Write your answer in the comment field below. He may deserve his own silver figurine at some point. But anyway, let's take a look at this one where he talks about price stability.
It also notes that price stability is essential for a sound and stable economy and supports the well-being of all Americans.
All right. Well, that sounds good enough. The only problem is if you look at our CPI index, which is generous as it is, I mean, this is just from 2015, and you can see that upward trending chart up over 26% since the lows of COVID. The pricing has not been that stable. Reminds me of when Janet Yellen said, well, if we stabilize the debt, then I think we're in a good shape right here. What would you say to that one about price stability in today's day and age, Punisher?
So as far as price stability goes, I don't really think we're going to have it the ways that we used to, say, from 2010 to 2019, before 2020 happened.
That also would have been funny if you just had said, I don't think we're going to have it, period. Please.
Just because we increased the money supply, and me being the way that I approach things, I'm very linear driven data analysis, meaning so when the money supply increases and you give everyone else money, you're going to have price increases just because of supply and demand. But what we're now seeing, if you actually look at some of the data, like durable goods, that data is going down. And so what's happening now is the cost of living in America, like your shelter, your electricity, and food. Good thing we have what they call as the core, where we like to take those things out of the inflation report. It's actually one of the things I've been focusing on and pointing out and explaining to people. They like to take that out of the inflation report, but actually that's actually higher than the regular inflation data because energy prices on a year over year are down. And so that's bringing the overall indexes down. And so actually, when you exclude the gas, the core numbers are actually higher than the overall headline numbers. Now, what that is doing is causing this distortion of price stability in the economy. And so like electricity prices are up, beef prices are up. So these are just all things that we need on a daily basis. And the way that the government created their inflation index is they like to strip things out. They like to do substitutions, all kinds of things. And so when we look at, that's why I actually look at the money supply as what the real inflation rate is, because that's what you're really going to get. And if you actually look, M2 money supply recently hit a new record high. And so the issue is we're not getting stimulus checks like we did in 2020. And so we're increasing the money supply, but it's not going towards like new iPads or new refrigerators
Although
or new
they're talking
watches.
about a new stimmy check too.
But the issue is, due to recent Trump filings, or I should say court filings, they deemed Trump's tariffs are illegal. Now, Trump is taking it to the Supreme Court in hopes that he can overturn the ruling. Because if Trump's tariffs are deemed illegal, the US government may actually have to pay back the money they took in so far in tariffs this year. And so that would actually hurt the deficit because it has helped a little bit, but we're still spending like a, no offense to my fellow veterans, but drunken sailors. And so the issue now is if the courts do rule tariffs are illegal in the sense that Trump is using them, then we're not going to bring in that revenue. And so now you're bringing up another issue. Not only that, that would be more fear in the markets, like what is going on with tariffs? And that ruling is going to be happening sometime around November, so within the next 2 months. And so when you have these tariff issues going on, or tariff questions and concerns, the run for gold and silver are going to be great because of that uncertainty and fear in the markets of what is going on. And then you're going to have these cases where you're going to have the president and the executive branch, basically doing it with the Supreme Court. And that's a good thing for actually America still, that we have checks and balances and that we're checking the president so that he doesn't actually over abuse his power. And so to me, that is a good sign. But as far as investing goes, that's going to create more fear and turmoil in the markets. And gold and silver, I think, are representing that.
Well, that kind of touches on my next question, is that the rest of this year going to be rather chaotic, like the first, well, we're in September, so two-thirds of the way through the year, and sounds like you think that the volatility is not about to calm down next week.
No, if anything's going to get, volatility is probably going to be your best friend going forward. And if you don't want to be in the VIX, I mean, that's why I said gold and silver normally have some of their best runs as the VIX elevates. And because you can have orderly selling. And I remember we had our talk previously when Jerome Powell announced that they stopped raising the interest rates at 5.5. I remember it was their last meeting. They said, we're done raising the interest rates. And we're like, well, why was gold down in that year 20%? That was because investors didn't know how high the Federal Reserve was going to take the interest rates. And so now most of the interest rate curve is between 3.5% and 4.5%. And so they're down from 5.5. And so now you're getting lower returns in the bond market. And so investors have been, loading up on gold and silver over the past 2 years. And so now going forward, if the Federal Reserve is going to be lowering the interest rates because the labor data gets worse, and we already know that earnings aren't as strong as projected, then you have Trump with the tariff turmoil, the end of 2025 can be a volatile one for the books.
Yeah, well, I guess the market is sniffing it out, Punisher, because as you're talking, up to 35.90 was up to 35.91 briefly. I didn't want to interrupt again. I'm working on that, but there's our VIX at 18. Sounds like you're thinking that may be a little higher before the end of the year. One other note about price stability. It's too bad Powell didn't read this quote from Paul Volcker during his speech. Would have been great. It says, it is a sobering fact that the prominence of central banks in this century has coincided with a general tendency towards more inflation, not less. Who would have thought? If the overriding objective is price stability, we did better with the 19th century gold standard and past central banks with currency boards or even with free banking, so again, it's not just you or I saying that what Powell is saying seems odd at times, but the former Paul Volcker saying as much as well. Although, Punisher, before we wrap up, I'm going to play this one. I can only imagine that this was. Now, on one hand, like you could say, well, he must have made a mistake, although he's reading from a speech. But Punisher, you and I have talked about how they started a couple back in May laying the foundation when they were talking about, well, we've only been discussing interest rate targeting. So if we have an inflation shortfall, then we can just run inflation hotter. No mention of the inflation surplus we've been left with yet. Anyway, take a quick listen to this gem.
In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2%.
So, inflation's hotter than the mandate, we'll raise the mandate anyway. If it's lower, we raise it. Basically, they're going to raise the mandate. Are you expecting that we'll hear more of this? Or what are your thoughts on the targeting talk that we've been hearing about in the midst of inflation that is still over the Fed's mandate for 4 years now, which they're going to bring down by cutting interest rates? Any thoughts on that one before we close out for the day?
Yeah, I just want to say that when it comes to the way they set up the whole 2% inflation targeting and how they run everything, if you actually look at inflation, I think the average inflation rate, whether or not the Fed uses the PCE, but if you actually look at like the regular CPI inflation, it's normally about averages 4% a year. And you can go back 25 years of data, or you can go all the way back to 1971 when we went off the gold standard. So it averages out about 4% a year. So their target is 2%. Reality, we get 4%. And that is, I think one of the only reasons why no one's really been out with pitchforks outside of the Federal Reserve building and or the White House is that, stock prices and real estate prices have gone up. And so for most Americans who own assets, they kind of don't really care too much about the 2% inflation target, because if their assets are going up, they're okay with it. It's the people who don't own assets that you're really starting to see. I actually put out on one of the, not an article, but a post saying that this next round of devaluation of the dollar is going to be the most painful. And what I mean by that is that during 2020, when we created and increased the money supply, we gave almost like $3,000 out to every single American. And so we basically injected, the trillions of dollars into the economy. And then what is that going to do? It devalues the currency. But at least everyone got some stimmy check to go purchase the latest iPhone, and it made them happy. Well, this next round of devaluation of the dollar, it's going to be painful, where you're going to see it in your utility bills, your food bill. And that doesn't, make Americans happy when they have to spend more just for the daily necessities. And there's no extra stimulus check coming. The other thing I want to add to that is that in the Trump's big, beautiful bill that he passed, benefits massively the homeowners, because they increase the SALT deduction tax from 10,000 to 40,000. So next year, when Americans who own housing can write off more on their property taxes, and it's going to be a huge injection of money next year. But who's going to be getting that injection of money? Only the people who own real estate, and that's only like 50% of Americans. And so those people are going to benefit. And the ones who don't have a house aren't going to get that injection or surplus as like a stimmy, say, for next year. And so again, you're having that next round of devaluation on the currency, but it's only going to go to a select few, and the other ones are not going to get that. So you're going to have this continual wealth divergence happening in the real economy.
Well, Merry Christmas. So there you go. And fortunately, Punisher, you are the antidote. And perhaps just in wrapping up, people want to stay ahead of this and know how to outmaneuver what is coming. Can you let people know where they can find Punisher's Coastal Journal?
Yeah, so if you check out Substack, is the Coastal Journal, where I help manage, and we put out 2 to 3 articles a a week. We like to go do forensic accounting into all the hottest stocks. That's where we got into NVIDIA recently, where we talked about how they were booking profits, but their cash flow is not growing, signaling a red flag in their earnings. The same with Supermicro and AMD and CoreWeave. We also looked at the tech earnings where their free cash flow declined across the board, which is signaling issues that their CapEx may be coming to an end, because with their free cash flow dwindling, how can they constantly keep spending on CapEx? And so I like to give this type of information out to investors who are managing maybe their own portfolios, who can't afford or reach the limits of portfolio managers. And so I want to help people understand that. I give strategies on like, well, if you want to own gold besides the physical, maybe there's an option strategy for people who want to add more. So I help people with different ideas to help them better off on their investments and portfolio strategies.
Yeah, I saw you even have your own trademark Punisher strategy, which is producing stock index like returns in bonds year to date in 2025. So it's good stuff. I sure appreciate reading it. The link is in the description field below, and also fun being in that chat we have going on Twitter with our amigo Dave Kranzler. And anytime some tech company does something incredibly stupid or fraudulent, you guys are on top of it. So either case, Punisher, thanks for making some time today. We'll have to get the Christmas edition of this up and running. I remember the first time you were on here, you had Christmas tree in the background, and we'll be there soon enough. No doubt my Jets, who it turns out Punisher was a Jets fan. He couldn't take it anymore. He threw in the towel about 10 years ago. But my hope is that by December, like, we're playing a game that means something rather than, thinking about, well, who's going to be available in the draft the second week of October yet. Punisher, I'm going to keep trudging through on behalf of both of us. Maybe when we're in the playoffs this year, we'll get you back on board. But either case, thank you for joining me. A link to the Coastal Journal in the description field below, and we'll catch up with you again soon, Punisher.
Thank you, Chris.